Welcome back to Lunch at the Market. What a cleanup day. We'll go through what we've done so far today. We sold out the rest of our puts on the downdraft at the open, and we have very few, if any, protective puts left. For those puts that we were short, we rolled down and out on puts and put spreads we were short. For instance, on Chesapeake, we were short May 23 puts and didn't really want to get the stock put to us with the stock trading with a $20 handle on it. So we bought back our May 24 puts and sold the June 21 puts, actually taking in a credit to roll out because volatility was still very high this morning. The only put options we have left that were short are terribly unlikely to be in the money, like our Apple May 210 put that we sold once this madness started for a pretty penny. We just don't think that the odds of seeing Apple fall more than $33 into the close, so we'll stay short May puts like that and collect the full premium for selling the put without paying a second commission to close the put, as will likely expire worthless. Also, it was time to sell volatility in the morning, so those of you who got long the VXX as a hedge back in January, February, March, and even April, when the VIX was below 20, it's time to take off your hedge for a maximum profitability. Could we see further downside? It's very possible, but rarely does the VIX stay this elevated for very long, and there's no reason to look a gift horse in the mouth. The trade has worked. You had a huge winner among a sea of red, and it's time to move on and raise some cash by selling what's been a great trade. We're evaluating the call spreads we put on yesterday. If we see a couple more days like this, it's likely that we'll see significant appreciation of these call spreads and look at taking them off once we're up 25% or more. Keep in mind that all of these call spreads for us are dated for September through December. We're also long plenty of calls on names like BP, Weatherford, Visa, and Cisco that we obtained this week when things looked terrible. Hope you avoided panicking this morning. What an amazing call from James Altucher, who came out before the open and put his money on a bet that will bottom by 10 a.m. and be straight up from there. He went as far as to say that the markets will be up the next 3 months. We'll jump on and say that our target for the S&P is 1213. So how do we get that number? S&P earnings should be $80 a share on the low end, and for more on this, please see our S&P math video on YouTube to figure out how these numbers are derived. Take the historical average of the S&P 500 and you can multiply that, which is 15.17, and multiply it by the earnings, or E, and then you get the P, which is price. That price is 1213. If either of those numbers are too low, either the S&P earns $85 or the PE reaches 16, then you could see at least 1280 on the S&P by December 31st. That's the upper range of our S&P guidance. Our range is 1213 to 1280. Okay, thanks for tuning in today, and hope this helps you get a glimpse of what we're doing over here. For more, you can view our nearly 150 videos on our YouTube channel by looking for MO Financial on YouTube. Also, if you want more from James Altucher, you can go to www.magnumopusfinancial.com/demystified, or you can go to www.magnumopusfinancial.com and click on the green box that says Listen Now in the middle of the page right above the MOF News Network buttons. That's it for us today, and we'll see you next week.